Good morning, and thank you so much for joining us for another wonderful REIT Hoya Capital webinar. I'm very excited to be joined by Scott Brinker, the CEO and president of Healthpeak Properties. Scott, thank you so much for joining us. It's so good to see you.
Yeah, thanks, David.
We have a little presentation on the screen. I'm going to zip through it. We're going to turn off the presentation, and Scott and I are going to have a nice little fireside chat. But as I mentioned, this is a webinar with Healthpeak Properties. They own facilities, discovery, outpatient care, the patient care research. You know, it's a very diverse story here when you also include their exposure to life science and senior housing. As we look at the story from their most recent investor presentation, company owns 702 properties totaling 49 million square feet, kind of tiny there, $25 billion of investments, a 7% dividend yield, BBB plus credit rating, very strong. Here's from their investor presentation. This kind of goes over the portfolio from a very high level. Half the portfolio, outpatient medical, your traditional medical office buildings and other stuff, lab space, and then senior housing, which we'll get into. You know, what's interesting when you look at the company from an overall, you look at the diverse tenant makeup here, and you've got household names to non-household names, let's put it that way, but a very, very big group of tenants to kind of unpack here. You look at the portfolio, and Scott and I were just briefly talking about this as we were starting, and you basically look at that, they're, you know, in many, many states. Biggest exposure as far as concentration of NOI would be in San Francisco, followed by Boston, and here in my backyard in Dallas, Texas. As we look at the tenant makeup here, they have a great slide in their presentation, looking at the pie, the exposure to a lot of the healthcare systems, physicians groups, and then all the other different sectors that make it up. You know, one story when we look at the world of REITs is dividend coverage. The company likes to highlight here the dividend continues to grow while the coverage, more importantly, the coverage continues to grow. And you know, it's how do you continue to grow? And I know Scott will get into this, but they have this on their presentation here. Basically, there are 5 key steps to platform growth. And so I have a bunch of questions that I will get into once we get Scott to share his thoughts with us. And so with that, Mr. Brinker, I will turn it over to you.
All right, thanks, David. That was quite an intro. I think you did most of my job for me, but I will share a couple of things before we get to Q&A. But Healthpeak really has a profound impact on healthcare discovery and delivery here in the U.S. Pretty good chance that most of the people on this call have been inside of one of our outpatient properties, depending on where you live, or certainly have taken one of the drugs or therapeutics that are discovered in our life science R&D properties. My career entirely is healthcare real estate, 15 years at HCN, now Welltower, and now 7 years at Healthpeak, really investing in every aspect of healthcare real estate. 2 great companies. But Healthpeak is S&P 500. We own 700 properties across the country and almost 50 million square feet with 25 billion roughly of gross asset value. So importantly, from a return standpoint, we do pay roughly 6.5% dividend yield. As of January of this year, we pay that monthly, which is nice. And we did increase our dividend most recently in January of 2025. And yet we retain a really conservative payout ratio so that investors can be confident in the dividend. And we also have free cash flow to reinvest into our portfolio. Strong balance sheet, BBB plus credit rating, stable outlook, and a debt to EBITDA in the low to mid 5s, which is right around our target. We did a big merger 18 months ago with Physicians Realty. Realistically, most mergers don't work. This one was an overwhelming success. It did move our outpatient portfolio mix to above 50%, which is a favorable thing given the supply and demand fundamentals in that business are very, very favorable, as strong as I've seen in 20 years doing the outpatient sector. It was also a success financially, more than $60 million of synergies, and strategically. One of my goals now 3 years into this role is to bring our company closer to the real estate. Ultimately, the success of our portfolio is driven by the health of the local healthcare operations inside of it. And we brought on a lot of talent from the physicians team that is helping us get up to speed in that context And we also internalize property management. So historically, our company outsourced the property management inside of our properties. We've now internalized that business almost across our entire portfolio. So more than 150 people are now on the ground in the local markets, interacting with our tenants, overseeing our properties, and they now carry Healthpeak business cards. So we're really excited about that. And that was a big part of the synergies that we were able to generate. We are one of the largest owners of outpatient real estate in the country. We've been doing that business for more than 20 years. It is a business that requires specialized expertise, not only knowledge of the local healthcare environment, but the regulatory environment and reimbursement, and importantly, relationships. So of that 40 million square foot portfolio, the vast majority is actually leased directly to hospitals or health systems. It's not a retail clinic with a bunch of physicians. These are big 70,000+ square foot, we call it outpatient because that's exactly what's happening. These are outpatient centers with ambulatory surgery, imaging, and as hospitals have moved more of their services outside of the hospital into these outpatient settings that are more convenient, they're lower cost, and you get better care, better outcomes. So they're preferred by patients, by the health systems, and certainly by payers. Very favorable demand fundamentals behind that business, and we continue to grow it. And importantly, the supply outlook in that business has never been more favorable. Today, the new deliveries are less than 1% per year of existing inventory, and demand is growing faster than that, which is favorable, obviously, for incumbents like Healthpeak. So in terms of occupancy, releasing spreads, retention, all the things that drive earnings over time, very favorable fundamentals in that business. And the reason for that is the cost of new construction is extremely high, and it's not going down. The rental rate that is required for a new development is massively higher than our in-place rental rates, and that's benefiting the incumbents and our existing portfolio. So a great time to have a big presence in that business, and most importantly, a team that can execute, and we certainly have that. And then our our life science business, which is about 35% of our portfolio. We own more than 10 million square feet. That's highly concentrated in the three core markets of Boston, the Bay Area, and San Diego, where you have 5 decades of infrastructure and ecosystem that's built up around venture capital, research science at the universities, nonprofit academic medical centers, and then importantly, the scientists and entrepreneurs themselves, who are creating innovative drugs that are keeping people healthy, and diagnostics to diagnose problems. We're one of the largest owners in that business. It was one of, if not the most favorable real estate subsector from 2010 through about 2020. It obviously attracted a lot of interest. And as it tends to happen in real estate, it does go through cycles driven by supply. And we're nearing the end of what has been an oversupply cycle. Deliveries peaked in 2024. They're going down dramatically in 2025. And as we look into 26 and 27, the number of new deliveries is going to plummet. And that should start to turn the supply and demand fundamentals in that business, benefiting incumbents like Healthpeak. And then on the demand side, the amount of research dollars going into this business is significant, roughly $400 billion. Public markets, private markets, off the balance sheet of big pharma. That's a huge number, and it continues to grow. It's compounded at more than 5% over the past decade. We see that continuing to grow because the only way these companies can replace their revenues is new innovative drugs. Their patents expire and the revenue goes to zero. So the need for R&D for those companies continues to grow, and the demand for the end product is clearly there as people want to stay healthy and live longer. So the demand side, we think, will be solid. This year, it's been slightly impacted by the regulatory environment. There's been quite a bit of chaos in DC. We think that starts to slow down in 2026 as Congress in particular turns their attention to midterm elections. So hopefully both the supply and demand picture starts to improve as we enter 2026. We feel like that's the case. In other words, approaching, if not at the bottom of that cyclical downturn, which is a good thing. And then we do own 10,000 units of senior housing. That's a portfolio that's continued to perform exceptionally well. Really, since 2017, so a 9-year time period, we've grown NOI on a compounded basis by more than 6% a year in that portfolio, which is pretty astounding given where inflation's been over that same period. but it also incorporates the COVID downturn in senior housing. So really high quality portfolio, great team internally that's managing it, in a really high quality operating partner. So we feel good about that business. And then maybe last comment I'd make is on our tenant base. It really is made up of industry leaders, huge health systems like HCA, that everybody would recognize names like that, but also regionally focused, best-in-class players like Honor Health in Phoenix, Northside in Atlanta, and those are by far our biggest tenants. And yet we also have a very well diversified tenant mix, in that only 2 tenants in the whole portfolio are more than 1% of our revenue. So a very well diversified tenant base, but we do make a point of trying to back industry leaders. Really a long time strategy of partnering with the number 1 or number 2 local health system, and that's paid dividends as those companies have continued to grow and capture market share. And then maybe last comment I'd make is in terms of capital allocation. The balance sheet's in great shape. Last quarter, we did announce 2 new outpatient medical developments that are essentially fully pre-leased at a 7.5% blended return, so a significant premium in terms of the yield versus acquisition cap rates. So that continues to be a great capital deployment opportunity for us, driven through relationships with health systems. And then in life science, the downturn is creating opportunity for the big incumbents like Healthpeak, who are capturing market share, for us to take advantage of distress. And I think we did the right thing in hindsight by pulling back on capital deployment into that business. Really 4 years ago is the last time we made a significant investment, in particular new development. And we're in good shape because of that. We don't have a lot of unfunded commitments. We don't have a lot of unleased development space. In fact, we have relationships and balance sheet capability to take advantage of other people's over exuberance. So we're excited to do that. And then obviously we don't like where we're trading. Our earnings multiple is at a cyclical low that we think creates opportunity. So we have bought back some stock in the past year, roughly $300 million. That continues to be an avenue we could pursue. We do think the company is undervalued. And both myself and the directors have bought stock on the open market this year, just to kind of underscore that point. So why don't we go to Q&A, David?
I guess we're done. Got nothing else to talk about. You hit it all. I mean, that was great. Thanks so much. And we want you to get back to your day. No, just kidding. That was great introduction. A lot of great stuff to unpack there. Got my head spinning actually with all that you just dropped there. So I don't even know where to begin. Let's take a step back though. I'm old school. Some of the folks on the call here might be old school. And I think about good old HCP. And you talk about the merger from now 18 months ago. Has that fully worked its way through? Are there still synergies to unlock post-merger? I mean, obviously it's proven fruitful because it's put you guys in a whole different spectrum, but is there still a lot more to unpack there to explore post-merger?
I mean, 18 months in, I think most of the synergies have been realized. We did, even in August and September, internalize property management in another roughly 3 million square feet of real estate. So those synergies continued really up through the current month. But as we look forward into 4Q into 2026, for the most part, the synergies from the merger have been realized. And I think the next thing we're focused on is really using technology. Given the scale of our platform, we can make investments in technology to make each of our people more productive, more efficient. So that's probably the next wave for us.
Let's pick up on that. Define technology. Is that AI? Is that custom built software technology in-house? What does that mean to the average person who's not familiar with how the world of healthcare works on your side?
Yeah, it's always going to be somewhat customized, but yes, mostly AI, and making a lot of our day-to-day processes and procedures more efficient, cutting out steps, automating steps. That's really phase 1 for us with technology that's very much underway, and we'll start to see the benefit of that as we enter 2026. And I think phase 2 is really how do we enhance the customer experience to generate more revenue. And we do think we're unique in that we have national scale. We're one of the biggest players in both outpatient and in life science. And we can invest in technology and people and platform, but ultimately real estate's a local business. And so is healthcare. And as a result, we try to get the benefit of national scale, but also local scale. When you look at our geographic composition, we are nationwide, but like 80% of our revenue comes from just 20 MSAs. So we're actually quite concentrated within that national footprint. We like to pick markets that have good demand, where we have a competitive advantage, and then deepen them. And you continue to see that with the investments that we've made in both life science as well as outpatient medical.
You briefly mentioned about adding services to basically push revenues. What kind of services could, and by the way, this isn't even part of the Q&A stuff I had even lined up. This is just you opening up all these ideas. What kind of service do you see potentially adding that could enhance that revenue stream?
Yeah, a little bit to be determined, but when you think about the core business of our tenants, they're the most sophisticated health systems and life science R&D companies in the world. Their expertise is not real estate. So there's a lot that happens inside that building beyond just leasing them real estate that I think we could be a value add partner to those big health systems, because this is not where they're focused. I don't want to say it's an afterthought, but this isn't how they differentiate themselves and create value. I think we can help them create additional value inside of that footprint. So it's that concept, but the specifics I'll leave to 2026 as we continue to build out that business plan.
You also briefly touched upon on-campus versus off-campus.
Yeah.
And I think that's something that a lot of the MOB guys discuss very regularly. From a high level, and I don't recall, maybe it's in the presentation, I missed it. What's the percentage of on versus off, and how do you potentially seeing that evolve if you had to use your little crystal ball?
Yeah. The majority of our outpatient buildings are on the campus of a hospital. It's probably in the 60% range, or if we include buildings that are close to a hospital, it would be even higher. And we do like that business. It's the critical mass of healthcare delivery that is important to consumers and to patients and to physicians. So that is important. But not much is being built on the campus. They're, for the most part, built out. And as healthcare is continuing to move outside of the hospital, we think it's important to be able to service that population who probably wants buildings that are more convenient, closer to their home in the suburbs. That's true of the physicians too, by the way. And so we like off campus as well. And they tend to be newer buildings, which has some benefit. But the important distinction for us is not on versus off. It's who is your anchor tenant and what kind of services are being delivered in that facility. So when you look at the off-campus buildings that we have, they tend to be very large, 50,000, 100,000, 150,000 square feet, anchored by a health system who's a market leader. That's critical. And then delivering high acuity outpatient services. So this isn't just physician clinic space or kind of a retail urgent care. Nothing against those businesses, but that's not what we do. When you look at our tenant mix, it's very heavily weighted towards ambulatory surgery, imaging, oncology, cardiac, ortho. This is not stuff that's easy to replicate. These are services that are hard to move. So our retention rate tends to be quite high.
You took the question out of my mouth, because from where I'm sitting right now, literally a block away is a Doc in the Box.
Yeah.
Right across the way from me in the shopping center is a physical therapy rehab place, literally like within a baseball throw away from me here. And so you basically just said, we're not looking to branch out to that. We are going to stay in our little crosshairs of what we're good at. All right. Well, let's jump into one of the questions that you and I came upon as we were talking about this. And this goes back several months ago. You've talked about it. You've hinted at it. You've talked about the upside here. But we talk about life science. And life science is a sector that has been under pressure for the past several months. As we know, there's a very big investor that's out there that's put one of your peers not really one of your peers, but one of your peers in the crosshairs, and that's Alexandria. As we were talking about before we hit live today, there was an article published on CNBC looking at the recovery of New York office, but then they say the one stock that has underperformed is Alexandria. And they're trying to lump in Alexandria to the New York office guys like a Boston Properties, SL Green, and Vornado. You're talking apples and oranges from where I sit. So you have addressed that life science has been under pressure. Does the tide turn in 26? Does the outlook improve? Is it going to take finding the cure for cancer to boost the sentiment in the sector? What levers do you think we need to pull for that to become, let's say, more in favor again?
Yeah, and Alexander's a great company, by the way. One of the true innovators and first entrants in the sector, 35 years. We've been doing it 25. We think we can compete with them effectively in our own local markets, but an excellent company, but nothing in common with the traditional office market at all. Completely different demand drivers. The type of services inside the buildings are not even remotely close. And the locations are night and day. They may have one or two buildings in New York, but most of life science is in Boston, San Francisco, and San Diego for good reason. It's 50 years of an ecosystem being built up with the scientists and the venture capitalists and the entrepreneurs, and importantly, the academic medical centers and universities that end up initiating a lot of this research or do the clinical trials. So yeah, that wasn't a great comparison by whoever it was that said that about New York office. The only
we're not gonna throw that author under the bus, even though they're very well respected on the street.
And no offense to them. That's just my own opinion. There's not much similarity other than New York office did come back because supply went to zero, or new supply, and the demand for the space went up. And we do see that happening in life science. I referred to it earlier, but I'll elaborate. The amount of deliveries in 2024 in the life science sector was something like 15, 16 million square feet. This year it gets cut in half, and next year it goes to virtually zero. And nothing is being put under construction today or anytime soon, other than maybe an occasional build to suit, but nothing on a spec basis anytime soon, because the economics just don't make sense. The rental rate versus the cost to develop new supply will go to zero for a long time. And we're already seeing demand come back. This regulatory chaos has not been helpful for the business. It's one that requires new capital to create demand for real estate. And we're starting to see improvements across the board on the capital raising side, whether it's the first IPOs we've seen in multiple months just got done. The XBI, so the biotech index, is doing better. Venture capital, they clearly have a lot of dry powder. So the fundraising has been strong. We need to see that turn into fund deployment. We're starting to see signs of that, both broadly and within our own portfolio. And that's really the first step to creating more demand. And we're seeing that in our leasing pipeline, which is the early stages, right? You don't go from a conversation to a signed lease overnight. You have tours and proposals and LOIs and all those things. And when we look at where our pipeline is today versus where it was 6 months ago or 9 months ago, it's continued to improve. So we feel like the initial steps of a better operating environment, we're starting to see those, which is obviously welcome news.
And it's a sector that just fascinates me, because you highlighted, like, the build out cost is so much different. The white space, clean zone, whatever that terminology is just different than any other sector that's out there. What, again, and you're more on the front lines of this, obviously, than what I am. What is the incremental, let's say, cost percentage difference between building out a life science space for, let's say, Pfizer versus a typical office building for a general tenant? Is it 50% more? Is it double because of the specialization needs? Or is it even higher than that?
It's probably 30 to 40% higher, right? Take away things like, Park Avenue in Manhattan, that's just an outlier in terms of cost per foot. But in the same location, to build a Class A office building versus Class A life science, it's probably 30 to 40%.
Interesting. Okay.
The infrastructure of the building is significantly higher floor to floor heights, higher floor loads. there are infrastructure differences in just the base building, but then obviously the TI build out is significantly higher for a wet lab than it would be for even really nice office space. But yeah, it's 30 to 40%, not 2x.
Let's put you on the spot. Are we going to find the cure for cancer in our lifetime?
I mean, I'm not a scientist, but I
Yeah, but
will
you're
say
dealing
that
with the tenants that are
yeah,
working on it. I mean, what's your gut tell you?
well, I mean, the advances in the last 20 years are astounding. And science really doesn't go backwards, it builds on itself. So we're pretty optimistic about what's happening inside of our portfolio. And a lot of that innovation is taking place with really the biotechs that are key tenants for us. And a number of them are having success, even in this difficult background, in working on types of cancers that historically would have been incurable. So, well, there's a cure, I don't know, because cancer has so many different variations. There's so many different types and the organs that it impacts. So I don't know if there's a universal cure, but the progress has been incredible in the last 20 years. So yeah, hopefully more to come.
Let's shift going towards senior housing. As you mentioned, it is the small sector that you guys have exposure to, but it is a sector that you do see evolving and growing. So how do you see that sector evolving over the next 10 years? Do you see yourself, let's say, significantly reshuffling the pie and growing in that? But also, how do I say this bluntly? That's a sector that's got way too many players in it. I feel like that's a segment that's ripe for consolidation. What's your thoughts about potential M&A? And maybe we can come back to that as part of a broader question. But what's your thoughts about senior housing and the evolution over the next decade or so?
Yeah, I won't speculate on M&A other than to
Come
say
on, come
other
on.
than to say it usually doesn't work. But there are exceptions. I think our merger was one of those exceptions. But I have been around that business for almost 25 years. It does go in cycles. The demand is almost always there. Other than for a year or two during COVID, that there's always demand. There's a societal need for the product. That's not going away. If anything, it's growing because of the aging population and the fact you have working age parents and kids who are working. And a lot of times they're in different geographies. So the need for the product is not going away. The challenge the cyclicality has always been new supply. And does new supply make sense or doesn't it? And that tends to drive the cycles in that business. And for 5 or 6 years now, there's been no new supply or very little. And that's obviously benefiting the owners, the incumbents in that business. Similar dynamic that I mentioned in the outpatient business, but even more dramatic in senior housing. And it's a lower margin business. So it's a 25, 30, 35% margin at best. So obviously there's a multiplier effect. When things are going well, they go really well. And when things aren't going well, that multiplier works in reverse. But the near-term outlook is obviously quite favorable given the aging population and very little new supply. At some point, those dynamics will change, but the near-term outlook is good.
I'm going to push back on you, and I'm going to say that the long-term outlook also looks very positive, and the reason being the product that you and I are going to live in, Scott, is
Yeah,
going to look nothing like the product that your kids are going to live in. I think we're going to see a huge turn in the supply that's out there and basically modernize it for the modern generation. We don't want to live where grandma and grandpa live. We want to live in something that we've grown accustomed to living in. So I think this is something that's going to look good for the personally. This is my take over the next 25 plus years. That's just
yeah,
my gut.
yeah. The demand will be there. My only point is the supply is more the variable. And so, I mean, real estate doesn't have huge barriers to entry. So yeah, the demand will be there. There's no question about it.
You started out the conversation talking about a couple of your recent transactions that you did. Can we maybe unpack that a little bit more? Maybe about the why, but more importantly, let's say what I like to call the sweet sauce. What was the sweet sauce of those transactions that made it so compelling?
Yeah. Last quarter, we announced 2 new outpatient developments in Metro Atlanta with a regional health system called Northside. If you live in that area, you'll certainly have heard of them. They have the #1 market share in that whole MSA. And they're in the northern suburbs, which tends to be the more affluent, better payer mix. So a very, very profitable health system that's growing and capturing market share. We have well over 1 million square foot leased to them in very successful buildings, and they continue to grow and capture market share. And for the most part, they're not building hospitals, they're building outpatient centers. And we were able to Finance fund their next two big outpatient centers, 100,000+ square feet, where they lease something like 85% of the buildings. It's an overwhelming number, and they obviously drive demand for the balance of the building too. So we'll get underway with both of those soon and hopefully open them in early 2027, if not sooner. And then in the life science sector, earlier this year, we did two, we'll call them distress opportunities, but as a lender. One in Torrey Pines, which is the best submarket in San Diego by far. Huge barriers to entry, huge history of innovation. We're one of the largest
golf courses.
Yeah, there is
golf courses too.
Yeah, very hard golf course. But we've had a 20-year history of success with our footprint in that market, and we had the opportunity to provide financing with a purchase option on a nice campus in that Torrey Pines submarket. So we closed on that earlier this year. And then our other big presence in the San Diego market is in Sorrento Mesa, right off the 805. We've got more than 1 million square feet of real estate there. And again, kind of the local scale in those submarkets is an important differentiator for us versus a new entrant. We like the campus model and having a lot of scale in very specific areas. And we have the ability to provide financing on a new development that's not leasing up quite as fast as the owner wanted, and they needed financing. And again, we were able to put some capital into that project on a loan basis at a nice return with an option to buy, which is our expectation in the future. We'll own it one way or another. Hopefully it leases up and we just buy it. That would be the upside scenario. But across the board, these are buildings that we want to own. And the loan structure really gives us a nice current return, a lot more security, but ultimately a pathway to the ownership of the real estate. So maybe just two examples within outpatient and lab of how we've been active.
You've talked about your coast to coast presence, top 20 MSA focus, or I guess really narrowing it down a little bit. If you had to look in the crystal ball, how would you say that maybe evolves over the next 5-10 years? You like the makeup? Do you see it shifting a little bit more? Is it following the migration trends and patterns? How do you look at that?
I think we'll continue to go deeper in the 20 markets that I just referenced. You know, we're in those areas for a reason. We like the demographics. We have a really strong local team in each scenario, and we have the relationships with the key players to drive internal and external growth. So there could be an exception where we can get into a growth market where we don't have a presence today in scale, and we would certainly be interested in that. But our priority is to go deeper in these markets where we already have a competitive advantage. They're good demographics.
It's my next question. You basically teed it up about your diversified, strong tenant base. How does that tenant base benefit the end investor? And the reason being, Johnny John, let me rephrase that, Johnson & Johnson, us old school Wall Street institutional traders, it was Johnny John. So the investor can go out and buy Johnny John stock, right? Obviously, they can go out and buy a lot of your tenants' stocks. How does your exposure to these tenants benefit the end investor?
Well, they're good credits. When you look at our top 20, 16 or 17 are investment grade credits. So that's obviously important for a real estate investor, but they're also growing. I mentioned Northside, and we've made it part of our strategy to partner with the leading health systems in these local markets where the MSA is growing, but also the health system is capturing market share. That allows us to lease up our existing buildings, but also create new opportunities if they want to do a development or a redevelopment or a new development that will be their first call. So that's why it's important to have such strong tenants inside the portfolio.
Let's curve real quick, though.
Yeah.
What happens if the healthcare systems merge? If Baylor Health decides to merge with X tenant and there's dual overlap and, again, synergies, does that provide opportunities for you? Are you guys actually excited when you see mergers inside the healthcare system? Because now you have an opportunity to modernize, monetize the existing property. What's your thoughts there?
Yeah, there really isn't much M&A in the outpatient sector. It happens occasionally, but it's already pretty well concentrated. I mean, HCA is a $100 billion company. So we don't see too much M&A. in that sector. When we do, it tends to be a strong system buying a weaker system, which benefits our real estate because our tenant is stronger. They probably can capture market share and invest into the local market. So when it happens, it tends to be a positive, but it doesn't happen often. And then in our life science portfolio, it's much more common because a reasonable amount of our portfolio are smaller, innovative biotechs. And when they have good success, they can either keep raising money and go all the way through commercialization, or more likely, they just get acquired. Because most of the drugs on the marketplace today, even though they're marketed and sold by companies like J&J, they're generally not the ones that are doing the research and development. They tend to outsource that to these smaller innovative biotechs, and then the companies get acquired. There was an announcement yesterday with Pfizer. I mean, it rarely does a week go by where big pharma is not acquiring a biotech. Obviously, it goes in cycles, but obviously a good example yesterday with Pfizer. And in those situations, and there's a lot of it that takes place in the portfolio. I think it's almost 50 times in the last 6 years in our portfolio where a tenant got acquired by big pharma. The lease gets affirmed. They can't terminate the lease. So you always get an immediate credit upgrade. Sometimes they're just buying a specific drug that's nearing approval. They don't need the people. They don't need the research. They just want the drug that they're then going to run through their own marketing machine. That happens occasionally, in which case, when that lease ends, you need to find a new tenant. But just as likely is they're buying that company not only for a drug, but for the platform in the science, and they want to expand across that area, not just one specific drug. And in that case, you get a better credit and a better balance sheet to grow. And it turns into a huge tenant for us, where they incrementally take more and more space. And there's a long list of successful outcomes like that.
Well, let's shift gears a little bit and talk about dividend, because you mentioned monthly dividend paying now. You had the great slide in your presentation looking at your dividend growth as well as your AFFO coverage, how that continues to improve. To the end user, when we think about REITs, we look at dividends. That's what we think about. So what are the keys to dividend growth? How does dividend continue to grow and evolve over the next few years, let's say?
Yeah, I mean, we want it to be an important part of our TSR, but not all of it. We feel like the multiple is at a cyclical low and has significant upside opportunity. And in the interim, investors being paid a roughly 6.5% current return, which they can reinvest however they see fit, which is a nice starting point for an investor. I know we certainly enjoy it, and it's not the only part of our total return. We want to grow earnings so that we can pay a higher dividend over time, but also so that it supports a higher multiple. And that's how we think about the dividend. It's an important part of the TSR, but it's not the only part. So we want to have money to reinvest into the portfolio, and we've set up a payout ratio that allows us to do that.
Tariffs. Are you guys impacted by this tariff conversation? Or are you hearing anything from your tenants in tariffs?
I mean, I'll add that to the list of uncertainty that's impacted the biopharma business this year. To date, they've been carved out of tariffs, but there have been plenty of threats made. But to date, really no direct impact. If anything, we could view it as a positive, and that the cost of construction will continue to increase, which makes new development that much less likely. That benefits our existing portfolio. So that's not super high on our priority list of all the things happening in Washington. That's probably the least impactful.
Okay.
Yeah.
That's encouraging. What do you think the future of healthcare looks like? And let's say the demand for convenience.
Yeah. Well, it's convenience and cost, because healthcare in the US is expensive. People are willing to pay for it because they want to stay healthy and live longer. But the burden of that healthcare is increasingly falling directly on the consumer, whether it's through premiums or copays or deductibles. And as a result, they have a bigger influence on where they get that healthcare. And we see that benefiting our outpatient portfolio. It's exactly what the business is designed to accommodate. And in the age of AI and telehealth, that probably does, on a net basis, improve the demand for our real estate. I think you can make a case that for some sections of healthcare, it may have a negative impact, that people can do things on their own versus going to a facility. But what we saw with telehealth 5 years ago during the pandemic, and I think we'll see with AI as well, is that it brings more people into the system. It grows the pie. They identify things and they come in for procedures or services. And that's really what our portfolio is designed to do. We do have some clinic space, of course, but the vast majority of what we do and what we build is services and on an outpatient basis. And I think that pie continues to grow with technology and certainly the aging population.
Keeping up at night these days?
Nothing. I sleep really well. I have a great team and great portfolio and balance sheet. So yeah, nothing.
Okay. Let's talk. We got, as I mentioned to our mutual colleague, Mr. Andrew, we got a bunch of audience Q&A leading into this conversation today. So we'll zip through a couple of these audience Q&As. What percentage of the revenue is from smaller hospitals or medical centers that could be affected by new Medicaid cuts?
Less than 10%.
Okay. Where do you think you would see the most weakness in, and what are you doing to potentially mitigate that weakness?
Sorry, I need a little more context on that question.
I guess of the three sectors that you're exposed to, which would you say? We said life science might be the weakest currently, but I guess to kind of put a bow on it, we think life science might be the weakest right now, but here's what we're doing. We're fortifying the tenant base, we're improving the lease structure, we're pulling the safeguards necessary so that your interpretation, Mr. User, is weak. We view that as opportunity. Does that make sense?
Yeah, but clearly that's life science from the overbuilding and the regulatory chaos, but we're starting to see that turn. I mentioned the leasing pipeline, the capital markets starting to open back up, new deliveries going to zero. So we definitely see the building blocks of a recovery in that business. It's not going to be a hockey stick back up, but we if we're not at the bottom, we're approaching it. And we have a super high quality portfolio, footprint, team, relationships to really outperform when that market recovers.
What about, let's say, concentration risk with a tenant, or with retailers, there's a list of tenants that are on a watch list. Is there a tenant watch list internally for you guys? And again, and how are you addressing that proactively?
Yeah, I mean, we have great diversification. We only have two tenants that are more than 1% of our revenue. One of them is HCA, who, $15 billion a year of free cash flow. And even with them, they're less than 10% of our total revenue, and it's spread across something like 40 different campuses. So we're really actually quite well diversified, even within that HCA footprint. The same is true with Common Spirit, who's our number two largest tenant with 3% of revenue. So we don't have single tenant exposure like some others would, but we do have a component of our portfolio that is leased to either private venture-backed biotech or smaller publicly traded biotech. And obviously those are the ones that we pay the most attention to, both qualitatively and quantitatively, to avoid surprises. And with our campus model and submarket concentration, sometimes we are able to move pieces around where a growing tenant maybe could take space from a tenant that's not doing as well proactively to minimize the impact of the tenants that don't make it. But that is one of the many things that I think differentiates the big incumbents like Healthpeak, that we can take actions like that, but also the quality of our credit monitoring, qualitatively and quantitatively.
So this is an interesting one. In your preference order, how would you raise capital for growing the business, such as a merger, acquisition, debt, preferred stock, common stock, or anything else that we haven't addressed? Like, what's your thoughts about cap raising?
Yeah. Priority number one for us is maintaining the really strong balance sheet that we have. So it would not be to lever up no matter what we do. What we've undertaken in the last 2 years, as the stock's been more impacted by the life science fundamentals, is to sell assets at accretive levels. We did $1.4 billion of asset sales last year at a cap rate in the 6.4% range. And by comparison to the remaining Healthpeak portfolio, those were on the lower quality scale. So it's not like we sold our best assets to raise the capital. We actually sold some of our worst assets, but at attractive cap rates. And that's at a point where we were trading at something like an 8 cap. So really attractive capital recycling. We bought back some stock. We did the investments that I referenced earlier. And that continues to be our mindset. In particular, in the outpatient business, the private market interest in that segment is very strong, if not exceptionally strong, in terms of the cap rates that they're willing to pay. And we have one of the largest portfolios in the entire sector, and we can use that as a source of capital if we see more interesting opportunities at higher returns.
The last two questions are kind of, let's say, stickiness type of questions. And then I do see we have one more question coming in here on the chat. So, previously, the trend was for doctors to join up with medical centers, medical communities, and hospital systems rather than going out and striking their own practice. Then we saw the trend reverse with more specialists striking out on their own. Do you see that reversing again, or what are you seeing out there?
I mean, for the last 2 decades, it's been an overwhelming trend. The sole practitioner model or small practice, it was certainly the clear majority historically. Probably 75+% of physicians fit that category. Today, it's the exact opposite. It's probably 75% that are either employed by a big health system or one of the big insurers or a massive physician practice that might as well be a health system. I don't see how that changes. I mean, the technology that those big companies and systems bring to the table is so powerful. And it frees up the physicians to benefit from that technology and not waste all their time on overhead and G&A and all the things that come with running a business. It's hard to imagine that really reversing.
Standalone medical office and ambulatory spaces have been the stickiest and most lucrative sector historically. Is that what you're seeing now? Or what is the trend out there, let's say on a sector by sector for asset longevity and tenant stickiness?
Yeah. Yeah. I mean, last year we had 85% tenant retention. This year we're running at a similar level. So it's always been a business with sticky tenants because it's hard to move a practice. If you think about it from the physician standpoint, their patients are accustomed to being in a specific office. And importantly, their referral patterns are critical to their business. And if they move their location, especially meaningfully, it can disrupt referral patterns. So for all those reasons, we very rarely see tenants voluntarily leave. It's usually because the practice is shutting down or they get acquired as the reason for the non-renewal, which is unusual. And today it's even more common to renewal because the cost of new development is so high that it's hard for them to move into a new development. They'll probably pay 2x the amount of rent that they would in an existing building. So, we're taking advantage of that in terms of high retention and releasing spreads that are as strong as we've ever seen. I think we had 7% last year. It's been 5 to 6% this year. So it's a very favorable environment for the incumbents. And that stickiness occurs even in economic downturns. It's outpatient is one of the 2 sectors in all of real estate that's had positive NOI growth for the last 2 decades, every year. Financial crisis, COVID, doesn't matter. It's positive. So, 3 to 4% compounded becomes pretty attractive, even if in any particular year it might be lower than what you can get in another asset class that has more volatile returns.
And what percentage of your properties are net lease?
Almost 100%.
Okay.
Yeah.
Okay.
Yeah.
So the last question, this is the easiest softball question for you, Scott. This is what you stayed up all night prepping for, was this question.
Okay.
Why Healthpeak? What's the value proposition for the rest of this year and beyond?
Yeah. Huge national scale, so that we have one of the best platforms in the sector, but also local scale, partnered with the best health systems, where we can drive a competitive advantage for better internal and external growth. And we're paying an exceptionally strong, well-covered dividend, and we're trading at a trough multiple. So we see a lot of upside with that multiple as the life science sector comes back, and we know it will.
Well, I want to thank you for giving up an hour of your busy day ahead of earnings season and all of this fun stuff that's on the horizon here. I'd like to give you the last parting word if there's any last message that you want to share that you haven't already, let's say, touched upon. And besides that, I can't thank you enough for educating our audience about the Health Peak story.
Yeah, thanks for having us. We got a great team. So we look forward to continuing to showcase that platform. Thank you.
Well, thank you, everybody. If you have any questions, feel free to send us a message, and we are here to answer your questions. And again, Scott, the Health Peak team, thank you so much for setting aside some time to start your day to chat with us. We really do appreciate it.
All right. Thanks, David.